Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And I know you're going to get tremendous value from the super experienced gentleman we're interviewing today. So his name is Max Sharkansky, and Max is the co-founder of Trion Properties, been around for a long time, done a lot of deals, and I'm super excited to have him on the show. Welcome, buddy.
Thank you for having me. It's great to be on.
Absolutely. So why don't you just take a few minutes and talk about why you're in the business, how you got in the business, maybe what your progression was, and if you did something before real estate, maybe what that was, and just kind of give us a feel for who you are and bring us to today, if you would.
Sure. So I graduated college right around the time of the dot-com bust, and I love the concept of real estate because it's tangible and you could see it, feel it, touch it. There wasn't the concept of these faux companies making no money worth hundreds of millions or billions of dollars. And it just seemed like a phenomenal business because it's a cash flow producing asset, tangible business. And it just seemed highly sustainable also, and something scalable and something to really make a career out of. Right. And at that time, I went and interviewed with some brokerage firms, and I wound up landing at Marcus & Millichap. I was a broker at Marcus for about 5 years. In my last year there, I started buying value-add multifamily along with my partner, Mitch. Mitch was on the debt side at HFF, doing a lot of larger institutional debt deals, and we started buying. And that's where we've always wanted to be full-time, was on the buy side, the investment side of the business. We didn't want to be on the services side. Not that there's anything wrong with that, but this is where we want to be. And I was brokering multifamily in the San Fernando Valley in LA. So naturally, we started buying multifamily in the San Fernando Valley in LA. That's where I had market knowledge. I had access to deals. So it was just a natural place to start buying. Bought a little 12 unit, then bought a 34 unit, raised money by calling friends, family, every single person in your phone book. Right. You do a pass the hat in the office, all your colleagues. Everybody, every single human being you know is how you start. And we were able to buy our first few deals. And when you're doing that and you've got a very finite amount of capital, including some of your own, you just turn the deal as fast as you possibly can to reinvest it in the next deal. We were turning around deals in 8, 9, 10 months, putting them on the market so that we could sell them in 12 months in one day to get capital gains treatment and then go on to the next deal, or we would exchange. And that's how we started doing it. In 2006, we left, opened up our own shop. We bought through the last cycle. We aggregated a small portfolio, and we were fortunate to have good timing. We sold most of the portfolio in 2008. And as we were selling in 2008, we went from targeting value-add multifamily to targeting non-performing debt secured by multifamily. We were a little bit ahead of our time because that was during the first wave of defaults. And our assumption, our thesis was a lot of these owners who own this aren't really owners because they're underwater. They're more zombie owners. So let's call the banks. And the banks weren't really willing to budge just yet. They weren't realizing.
That changed though, didn't it?
It sure did. It sure did. Yeah. The bid-ask spread was so huge because we would call these asset managers who would hang up on us, and we would say, like, we'll give you 65 cents on the dollar for this loan because, I mean, look at the value of the real estate. So here's what's happening. And we would try, the ones who weren't hanging up on us, we would try to rationalize with them, but there was no point. So by 2009, we bought our first few notes that were 65 cents on the dollar.
Nice.
And from there, it snowballed. And we had a really nice downturn, did about 20 deals, about 15 of which were non-performing debt, about 5 that were just REOs. During that period, we did not do a single deal that was just a private deal that we bought from a human being. Everything was.
Let me stop you for one moment, just because there may be listeners who don't understand what you're describing here. So guys, a Bank REO property is a property that's owned by the bank. They're not in the management business. They need to get rid of it. They need to get it off their portfolio. And I mean, you guys did time it freaking perfectly. Now, of course, you capitalized on it as well, which is fantastic. And so what they would do, guys, is they'd go in and they'd go to the bank, they'd buy the debt at a discount from the bank. And then what did you do? Foreclose or negotiate with the owner to take title? How, was it everything under the sun to get title?
Everything under the sun, because every note was different. Every property was different. Every borrower was different.
Right.
It depended on their equity. Once we got pretty deep into the downturn, when we were coming out of the downturn, rather, in 2012, when things had started to recover and we did some of our last deals. I mean, some of those were just payoffs, which were really nice. The lender that we bought it from didn't have the common sense to just call the borrower and ask them what was going on. So there were some notes. There was a portfolio of notes in 2012 that we bought at 80 cents on the dollar. The day after we closed, I called the borrower. I said, "Hi, this is your new lender. This is a friendly call. We're not going to try to pursue recourse or anything of that nature, but we'd like to do a deal on it for a cash for keys, just a deed in lieu of foreclosure." She said, "I don't know what you're talking about. I'm going to pay you off. We're under app for a refi. We're going to make the loan whole." Wow. And for us, we were putting debt on debt, so we were putting 75%. So of the 80 cents, we only put in 20, and we got paid 100. So we made 2x in like 90 days. It was pretty awesome.
Nice. Wow, that's slick, man. That's absolutely awesome. Now, at first I was like, man, you buy and sell everything. I've had some huge operators on my show that, and it's not often that, I mean, it's not uncommon for me to hear them say, we regret every deal we ever sold. We like buying and holding, but when you told me, because you started talking about moving into 08, and I was cringing because most people know my story of losing everything, but you were able to sell in 08. So that model worked very, very well. What about, let me throw something at you. What about, because I'm sure you raise money now, and that's why most big operators do it, but what about just buying and holding and refinancing, paying your investors back and just creating legacy assets? Have you ever done that model, or has it always been buy and sell?
So we started to change our business model a little bit. Coming out of the downturn, we went back to value add multifamily, and we just started doing it on a larger scale, right? So instead of buying $5 million deals, we started getting into 10 and 15 and 20. And we actually just closed a couple of weeks ago on our first 9-figure deal. We bought a $108 million deal in Orlando with $118 million capitalization, closed on a couple $80 million deals this year. So we've really grown our average deal size. Wow. And we've also changed the model of in and out in, under 18 months, of course, because you can't renovate 350 units in 18 months. So we've gone to a little bit of a longer term hold strategy. And one of the things we're looking at now, we've been looking at over the last year, is putting together a portfolio and recapping it, doing a recapitalization, because a lot of those investors who invested, they want to make their IRR, they want to get cashed out. And we can then go along with our next capital partner with a different strategy, right? So we've held these properties, let's say 2.5 to 4 years, and we can cash everybody out. And then we bring in a new capital partner on the new valuation, and we hold for another 7+ years. Nice. So that's how we're looking at long-term holds.
Interesting. And, and of course you can play with the splits and the preferred returns and all that stuff. You've got an asset that's performing extremely well. You can modify the terms and certainly make them certainly attractive to investors, but also attractive to yourself and improve your holding, position and whatnot. Love it. Love the strategy. I want to circle back to something because what I found in interviewing hundreds and hundreds of, some of the most successful operators on the planet as it relates to multifamily is very often, they're almost always they're a partnership. There's almost always at least 2 members in the team. And it's very often an analytical person with a more outgoing person. And now if you sold for Marcus and Millichap, there's no question that you're good with sales and you're great at building relationships. Then you told me your partner's in finance, which is very analytical, very, data driven. And, like my partner came from finance background as well. And you can throw him in a locked room with a spreadsheet and throw raw meat in once in a while. And he's thrilled. So is that the dynamic in your relationship there where you're out there probably more relationship driven? I mean, obviously you're analytical as well. You couldn't have worked with Marcus if you weren't, because you had to do pro formas and things of that nature. But just curious if that's the dynamic in your relationship.
No, not really,
No?
because he
Okay.
wasn't a banker or like a heavy
Okay.
analytical guy. He was a
Okay.
mortgage broker who was a very big producer. So
Okay.
same kind of thing, very
Okay.
outgoing, gregarious, extrovert.
Okay.
He was a little bit, because he had started as an analyst and went through HFF's analyst program.
Mm.
He was much better than me at Excel and modeling and, running like 5 to 10 year cash flow models. And
Right.
I was
Right.
not good at that.
Right.
I understood it conceptually, and I still do. And I'm great at everything conceptually, and can do a lot of the numbers in my head.
Mm-hmm.
But cash flow modeling was not my thing.
Right.
I was very good at understanding the business plan, finding the deal, negotiating the deal, capitalizing it, and doing all that.
Have you guys fallen into individual roles inside of your partnership? Like, do you do more of that? He does more of what, asset management or something else, or do you both do everything? I'm just curious because this team concept is most of the people listen to my show are aspiring or even very successful investors, and they all know that it's a team business, that you don't have to do everything yourself, and you frankly shouldn't try. Have you found in your team, we'll just stick with team for a minute, that you do more of a certain thing and he does more of a certain thing? Can you speak to that?
So touching on what you said, let's talk about the team, because it really is all about the team, right? Forget about just the two of us. So one of the things that separates us from a lot of our peers is we insource. We don't outsource. As you know, you've interviewed a lot of people, a lot of sponsors in the industry. They outsource their property management, their project management, their accounting, and it winds up being like 2, 3, 4 people in an office running this massive portfolio that just seems a little bit odd. We are the opposite. We insource. So we do property management in-house, construction, project management. Construction, of course, you do a combination of insourcing and outsourcing, but
so you're totally vertically integrated.
Vertical.
Completely. Okay.
We're vertical.
All right.
Accounting's in-house. We've got a full accounting team that continues to grow, feels almost like by the day, because accountants are mission critical. So we have a phenomenal team, and everyone's great at what they do. We have fantastic people in acquisitions, fantastic people in operations, property management and project management and construction, fantastic people in accounting. So we've got a pretty big team. And then that makes everybody boots on the ground, our employees also. So we have a very, very large team. And
how big is the team with counting the people on the ground? Approximately
it's about 70 people.
Wow.
Now, going back to me and Mitch, when we started, going back to when we started in 05, 06, like I said, Mitch was a very successful mortgage broker who had quite the book of business. And what I was good at was finding deals and kind of figuring everything out. And he had this great book of business that was really active in the last cycle. So when we started, as you know, when you're doing real estate deals, you can't really keep the lights on unless you have fee income.
Sure.
So what we were doing is, and this would help capitalize our deals, is we would show like we have very light fees on our sponsorships. And he was continuing to work his book of business and continuing to bring in mortgage fees to keep the lights on.
No kidding. So he was contributing that mortgage business to your business, mortgage fee income to the mortgage. Well, that's really cool. That's really cool.
And what we wound up doing is he grew that out. Or, we grew it out together. We're both 50-50 partners in both companies. So we started a separate company called Continental Partners. And Continental Partners is a mortgage brokerage company. So he spends a lot of time on that and with those guys.
Still to this day?
This day, yeah. It's its own machine. It's got about 10 brokers.
Wow.
And so he spends a lot of time on that. And then on the Trion side, he spends a lot of time, I would say, more on the capital market side of it, debt, equity, capitalizing the deal, understanding all that. On the acquisitions front, making sure, more of like our own mini IC. So making sure the deal passes muster before we move forward with it. So
wow. So what was it like to take down that huge deal in Orlando? Did the hair on the back of your neck stand up? I mean, that's a lot of zeros, brother. So talk about that deal for a minute, if you would. I mean, Orlando is such an incredible market, and I'm sure it was scary with COVID and everything, and the impact on Disney and Universal, but it's bouncing back already. So, tell us about that deal, if you don't mind.
Sure, I'll tell you about the deal and also tell you how we got into Florida and the Southeast.
Okay.
Being from California.
Right.
So we started, I moved here. I've only been in Florida for a few months. I moved here.
Oh, you live in Florida. Oh, okay.
Yes, yes. I moved to Miami. I'm in Miami.
Okay, nice.
Our office is in South Beach, but we're about to sign a lease on some space downtown. So we're going to be in downtown Miami starting April 1st of next year.
Love Miami. I lived there for 2 years. Love it. Now, of course, I was single and stupid. I had the Lamborghini and all this stupid shit. And I was, like a escaped convict after my divorce. But anyway, please continue. Love Miami. I'm here in Sarasota and I make fun of it because old people live in Tampa and their parents live in Sarasota. Okay. So I'm in Sarasota. So I'll be lucky to see one good looking woman. I'm madly in love with my wife, but I'm not dead. So I'll be lucky to see one good looking woman here in 3 months. And in Miami in 30 seconds, there's 5 of them walking down. Anyway, I digress. Please continue.
So it's a different environment for sure.
It is, yes.
So I moved out here on June 14th of this year. Mm-hmm. And we had already hired somebody to work acquisitions for us. And he and I were pounding the pavement, meeting with brokers, and we met with some brokers here in Miami who had a deal up in Palm County that we got really close on. And that deal wound up not working out, but I shot him an email and said, hey, I don't know if we're going to get there on this one. What else do you have coming up? As we do oftentimes. Sure. And he said, hey, I've got this deal coming up in Orlando. I replied, will the seller consider an offer to preempt? We'd love to work on it. Sounds like a really interesting deal. Disney had a master lease on, or still does, on all 384 units. We love the in-place cap rate. The lease ends in 18 months, April 2023. 18 months from closing, which we just closed a couple of weeks ago. And from at that point, we take over and we start the renovation plan and the value add business plan. So
wow.
We love
so they lease the whole complex for another 18 months.
Correct.
Wow. Were you able to communicate with them? I mean, of course, they're not going to tell you what they're going to do 18 months from now, I suppose, but any idea? I mean, are they out after that? Do you plan to have them out after that? Do you plan to start from scratch and release the whole thing, or what's the plan?
So they are going to terminate their lease.
Okay.
They currently have it leased out to just regular people, as opposed to what they had it before. It was used for their internship program.
Oh,
so
okay.
Disney used to do that, where they would lease entire communities. Okay. And they would put their trainees into the apartments. They have since ended that style of housing. They still have their trainee program, of course. We're talking about one of the largest companies on planet Earth. Right. But they've built their own housing, I think like 10,000 units close to the park.
I see.
And what they did is they hired Lincoln Properties.
So they basically subleased the whole every unit to individuals, which so you can just take over that. Well, that's fantastic. So it's just like a normal purchase, really, in that regard. Except you're not going to have any bad debt for 18 months or any loss to lease or anything like that, because they're covering the whole thing. Yes,
it's a triple net lease. Correct. It's a triple net lease north of a 5 cap, which in this day and age is impossible to get.
Wow.
And then it'll dip probably into the high 3s or low 4s once we take over, and then we start our management.
Very nice. What year was it built?
2008.
Oh my God, it's damn near new. God, that sounds exciting. That's really cool. That's really quite a story. Holy cow! Now, I'm sure you raised equity for that. Did you get private equity as well? I'm assuming you brought in some big players.
Let me talk to you about that. So we were going to do it with one of our institutional relationships. I signed the PSA, and then shortly after that, they said they couldn't get comfortable with some of the issues with the deal, and we now were hard on millions of dollars because we had to go hard at PSA. So we were hard on millions of dollars, and
that's a scary night. That's a scary night.
Like you said earlier, that's what'll put up the hair on your back.
Right.
And we were able to syndicate it out. We have been very active in crowdfunding over the years. Ever since the Jobs Act passed in 2012, we've been very active with crowdfunding.
So you've been on some of the platforms, some of the big platforms?
Yeah. So I called the guys that we know over at CrowdStreet, and they said, we'd love to do this deal. We've been super active in Florida. We gave CrowdStreet a $20 million allocation on a $32 million equity check, and CrowdStreet did a phenomenal job.
Wow.
Raised the money in, I think, a matter of hours.
Wow.
And then we raised the balance of our own. We're big syndicators. We love the high net worth business, and going out to
Sure.
all of our investors, and we've
Sure.
nurtured that over the years, and we've grown our database.
Well, if you're
to
buying and
1,000+
flipping,
investors.
yeah, if you're buying and flipping and you're giving those returns every couple, 3 years, I
That's
mean,
right.
your investors freaking love you. That's one of the biggest advantages of that model versus buy, refinance, hold. Because they're getting these big multiples on their money very quickly, and so I mean, they're not going anywhere else when you do that, and they'll tell everybody they know. So that's how you did it.
Bingo.
I love it. Oh, that's very
that's exactly
cool.
right. When you make people money, word travels very fast.
Oh yeah.
We've gotten a lot of word of mouth. We've done a lot of online marketing. We've done a lot of crowdfunding, and now we stand at about 1,000 investors. So
that's awesome. That's awesome.
we were able to syndicate out the deal, and we closed it with 350 investors, I believe, or more.
Wow.
Yeah.
Wow. That's awesome. Wow. Well, that's super exciting. Congratulations, buddy. That is freaking very, very, very cool. So you're vertically integrated. Do you have in Miami?
Well, I'm sorry. So we're vertical. Our headquarters in LA.
Right. Okay.
It will probably always be in LA because we have a very heavy accounting and operational presence there, and we have a huge office with a lot of talented people.
Right.
And my partner and I decided summer of 2020 to open this office here so we could target the Southeast. It was really a couple reasons. The politics in the West Coast.
Be careful. Yeah. Don't get me started.
Yeah, I know. I'm not going to get into politics on your podcast.
Okay.
I'm sure.
Okay.
That's not what your listeners want to hear.
No, listen, I don't really care, but I'll probably lose half my listener base if I express my mind. So I'm just gonna leave it alone. But yeah, please continue.
Yeah, I'm not gonna. Yeah, we don't have to get into personal politics or political philosophy, but it's just gotten pretty vicious towards our industry the past 5 years or so in California and some of the states on the West Coast.
Yeah.
And there's constant ballot measures and legislature on
scary stuff. Scary stuff that they're trying to throw it in. I won't buy in a blue state, and that's not a political statement. That is a business decision based on the fact that they're landlord averse. And I get a little hate when I say that publicly, but the bottom line is, why would you do business in a state that doesn't want your business, that's gonna kick your butt as a landlord? So go to a state that welcomes new business, and certainly there are a lot of them southeast for sure. So again, that's not a political thing. That is just a sound business decision, in my opinion. So. Exactly.
Yeah. And, well, we saw what happened in New York. So New York passed that very draconian vacancy control law, and a lot of people in our business got wiped out. Property values went down by 25% plus, which is your equity in a deal. So your equity goes to zero and you're bankrupt. And it's just a really scary thing. So number one, we wanted to diversify out of California, not leave California and leave everything behind. It was really a matter of diversification. And we have also diversified out of certain markets in California. Like, we're no longer in like the deepest, bluest markets. We're, in Sacramento and some markets like that.
Right.
And the other side of it is just the tremendous amount of population growth and job growth and economic growth and all the great things that are happening here in the Southeast.
Oh, yeah. 80 million baby boomers getting old and getting cold. They're gonna head south, right? So,
I like that.
Yeah.
So that's a part of it. Well, it's not just baby boomers. It's also now look what's happening.
Exactly.
Microsoft and Blackstone and
they're moving to Texas. They're moving
now in Miami.
Right. They're moving south. Exactly.
Tampa, by where you are, it's just
huge.
Tampa might be the best market in the country right now with what's going on there. It's incredible.
I don't own anything there. I haven't been able to find anything that made sense. It's just crazy how strong it is. So let's shift gears for a minute. Do you feel like we're headed for some serious inflation?
I do feel like we're headed for some inflation. I think one has to be pretty foolish to think that you can print $6 trillion with zero consequence. So,
thank you.
I mean, Econ 101, right? I learned this in community college when I was 18 years old. Mm-hmm. If you print money, you get inflation. And we're going to have some inflation. I don't think it's going to be to the degree of certain South American countries where you've got.
Well, pray God it doesn't happen like that. Yeah, let's pray that doesn't happen. But I think it's going to be bad. But see, the beautiful thing though is we're in the perfect business for that, because what else goes up? Rents, right? So I mean, I can't think of a better asset class to ride that inflation than the one that we're in. So Yeah, but well, listen, I know you've got a hard stop here pretty quick here. And, this has been a lot of fun. In fact, I probably want to have you back on at some point. We'll dig into some of the other sides of the business, asset management, property management, maybe even some more on the acquisitions front. But it's a real pleasure to meet you, Max. And very impressive. Congratulations on that Orlando deal. That is absolutely freaking awesome.
Thank you. Thank you.
But pleasure to meet you, my friend.
Nice to meet you too. If you're ever in Miami, give me a call.
I'm there all the time. We love it. We love to go there. Tiffany and I, my wife, we love South Beach. We love to go on Lincoln Road and people watch and just enjoy the energy of it. It's just a real vibrant energy. It really is. Like I say here in Sarasota, it's like, oh, good Lord, please, I'm going to fall asleep. But yeah, that's why we love to go there. But anyway, pleasure to meet you, my friend.
Good to meet you too.
All right. Thanks.
Talk to you.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our Warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our Warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 72345 and we'll set up a call so you can check us out and we can check you out. That's mentorwithrod.com or text CRUSH to 72345.